Detroit market update, industrial, office, retail, opportunity zones, investment. I don't know how y'all are going to cover that in an hour. That's a mouthful. Here's the guys. I'll let you introduce them. But Barry, you're the moderator. I'm just going to get out of your way here, and I'll let you take over.
Thank you. Welcome to the second panel today, the Detroit market update. In today's panel, we plan to address the office, industrial, retail, and even multifamily state of the market, both kind of pre and post-COVID, really for the state of Michigan and even, quite frankly, the Midwest. We put together a fantastic panel today of experts from the respective fields, covering everything from investment property sales to capital markets and debt placement, as well as cost segregation. My name is Barry Swatsenbarg. I'm the Executive Vice President here at Colliers. I've been an investment property broker myself for just over 20 years. Run a team of 6. At any given time, we're valuing somewhere between $300 to $400 million worth of real estate, and about half that amount is active in investment property sales. Plus, we also run a robust auction platform that we've been a part of with 10X for the better part of 10 years. What I'm going to do, since unfortunately we're not next to each other, and I can nod to move along with the introductions, is systematically move through the group and let each of the panelists introduce themselves. After introductions are done, what we're going to do from there is really just move into the topics, ask questions. It's an open forum, so the panelists can kind of throw to each other or even back to me if they like on those topics. And looking forward to a fun conversation with some folks I know quite frankly very well. And hopefully you get a lot of good feedback out of it as it relates to our opinions for the marketplace. So to make it easy, first up, Dennis, why don't you start, followed by Craig, and then Steve as it relates to introductions, please.
Hit your mic button.
I don't see Dennis on the screen. Oh, there. Oh.
I see him, but he's not able to. We're not hearing him. Dennis, if you're, let me just see here quick. I'm showing your microphone's not on. There should be a blue button top of your screen, or you can just pop out and pop back in. We'll see what happens there. You want to just move on to the next one, and we'll try to help Dennis in the background. You got to turn your mic on too.
Oh, there he is.
Okay.
Sorry,
hey. I was in the. I was in the proverbial black room with nothing going on in there. Sorry about that. All right, is my mic on now?
Yep.
Okay. I'm Dennis Bernard. Obviously, I'm technically challenged, or maybe I've used my laptop for things I shouldn't have, and that just couldn't get me online. But I'm Dennis Bernard, president of Bernard Financial Group, the largest commercial mortgage banking and servicing firm in Michigan. We average between $1 billion and $1.5 billion in commercial mortgage placements a year, and that's in all product type between multifamily and industrial, retail, office, self-storage, seniors, and so forth. We're a little unique. We service all of our life and CMBS loans. So we are actually a primary servicer. We service a little over $1 billion, about $4.3 billion in loans. So we've been active in doing modifications on our CMBS loans recently. And we do everything right here in both our Southfield and Detroit offices.
Craig, why don't you go ahead with your intro?
All right, sounds good. Hello, everyone. I'm glad to be part of the panel today. My name's Craig Miller, and I am the president of Duffy & Duffy Cost Segregation. We have offices in Detroit, Cleveland, and Columbus, and we are an engineered cost segregation consulting firm, and we are the primary cost segregation consulting firm for the Michigan Association of CPAs and its members, the Ohio Society of CPAs and its members, and the Pennsylvania Institute of CPAs. Michigan, Ohio, and Pennsylvania is our primary market. We do work in all 50 states. We have actually done work in 33 states. I've been a CPA for 24 years and a member of the American Institute of CPAs, and prior to 2007, when I joined Duffy and Duffy, I had never heard of cost segregation, and many owners and developers out there hadn't either. I was surprised to find. As time has moved forward, though, our industry and developers and owners and individuals are realizing that the cost segregation study is the most valuable tax tool for real estate. Every year, the accounting and tax publications rank the top tax techniques for business, and the cost segregation study is always in the top 10 tax techniques for owners or operators or developers of property used in a trade or business. I'm happy to report that with the very favorable 2015 PATH Act Congress adopted and the 2017 Tax Cuts and Jobs Act, the commercial real estate sector was by far the largest beneficiary of both those tax bills, and the cost segregation study industry continues to grow. So I'm looking forward to sharing some success stories from some of our clients and the interplay with cost segregation and the new qualified improvement property and the interplay with opportunity zones today with you and the attendees.
Thank you, Craig. Stephen.
Hello, everybody. Thank you for having me, Midwest Real Estate News, and I hope everybody is well out there in these kind of crazy COVID times. My name is Steve Chaben. I'm a Senior Vice President with Marcus & Millichap. Marcus & Millichap is a international offices in Canada and the U.S., about 90 offices all in. We specialize exclusively in income property investment sales. Within that specialized niche, however, we are full service, working all product types, from the core product or the core product types of apartments, office, industrial, and retail, and specialty product types across all the spectrum, hotel, motel, senior housing, self-storage, et cetera, et cetera. Again, pleasure to be here. Look forward to sharing my comments.
Thank you. Let's dive kind of into the questions and then start the conversation amongst the group. Stephen, since you were just speaking, I'm going to go ahead and keep going with you, kind of out of the gates. When you look at the experiences that you've had during this COVID disruption, are there any things that you've seen in the marketplace that you would expect to continue in the foreseeable future as it relates to commercial real estate?
As it relates to the market or how we're executing?
I think it's just, I think so many people are looking at COVID and saying, hey, this became an all stop to commercial real estate. It created a lot of uncertainty. It put a big pause into the capital markets. And, kind of on the back end of that, as we're coming out of it, are there any changes or trends that you've seen either with buyers or sellers that you think is going to be carried forward over maybe the next 12 months that maybe wasn't there pre-COVID? We're just looking for some trends kind of due to this disruption.
Sure. Well, it's been certainly a very interesting year. I would say we started the year prior to COVID looking at a marketplace that was fundamentally very sound, and there was a tremendous amount of capital earmarked for real estate transactions, both on the equity and debt side. COVID hit in March, and that initially created quite a shock in the marketplace. The debt market really pulled back significantly and quickly. Buyers, in terms of our transactions, it was interesting that we were able to keep most of them together, but it took a lot of work and tenacity to do that. But by and large, the transactions we had in the pipeline when COVID started, we were able, by and large, to get closed. When it came to new business development, things got very slow. I would say things were very, very slow through springtime. When the economy started opening up again, the market started opening up. The debt market pretty quickly found its place. And today we're looking at a debt market that is, and Dennis will certainly elaborate on this, but very favorable by and large to most product types. If you compare this downturn to the financial crisis of 2009, 2010, when there was no debt market whatsoever, we're seeing a much more liquid market, and that has been very meaningful in terms of transactional velocity. So certainly transactions are down. There's still a lot of uncertainty out there, but you really want to avoid generalizing. It's really product type by product type, market by market. There's some marketplaces and product types that, frankly, may be doing better than pre-COVID. We've seen compression in cap rates in certain single tenant markets. I have a team in my Detroit office that specializes in affordable housing sales, and they've been on fire, frankly, this year. And where you're seeing the activity go is stabilized deals. So again, investors, there's a lot of uncertainty, but where they can find certainty and stability, we're seeing tremendous activity. And frankly, with interest rates where they are, and the amount of capital that was still on the sidelines. I mean, that capital that was looking to enter the marketplace at the beginning of 2020 didn't go anywhere when COVID started. It just had fewer places to go. So those targets that exist where there's still stability and favorable financing, we're seeing lots of buyer activity. So on those types of deals, we are seeing lots of activity. And again, pricing is, I would say, stayed pretty much intact, and in certain examples, even compressed a little bit. On the other side of the coin, certainly there are product types and markets that are more challenged. Hotel motel is an example, multi-tenant retail. I would say those were the two product types where we're seeing the most distress. But even there, I've got agents working in all product types, and I would say there's not a product type where there still is some activity. In terms of the distressed properties market, we're not seeing a lot of it yet, and we don't expect really to see a lot of it. But it is spotty, and where it exists, certainly it will exist. In terms of moving forward, I am quite bullish. Certainly, we still have the challenge of the pandemic. When we get on the other side of that, I'm not the guy to ask about that, but I believe when we get on the other side of that, to a large degree, I think there's a lot of pent up demand out there. And in terms of our business and the transactional velocity that I would anticipate seeing subsequent to that, I really believe we'll see a wave of activity and the marketplace rebounding in a reasonably efficient fashion.
Thank you. Dennis, based on Stephen's responses and thoughts in regards to the marketplace, where do you see the capital markets on either the product types or even specific locations in Michigan that would be challenging or not challenging? Essentially, post-COVID, what are you advising your clients to do on the debt side, whether it be for refinancing or acquisition?
Okay, thanks. Candidly, I wasn't listening to Steve, and so I really don't know what he said. No, actually, I want to build on what he said. What he said, I do want to build on what you said, because he's right. He's spot on. When COVID came along, I'm going to back up just a little bit because I want to build on. Steve was just very correct. Coming into COVID, our capital, unlike the Great Recession, our capital markets, our lenders were never in better condition. They were liquid. They had very few non-performing loans, and they had incredible amount of capacity that they needed to put out. So they did only go to the sidelines for about 3 months, and now they're all back. Now all the product groups are all back, but not all of the lenders within the product group are all back. For instance, at one point we had 28 CMBS players. Now there's only truly about 12 of them. Some of the life companies who specialized in certain product types have narrowed what they've done. So to build on what Stephen said, we were in great shape before, and they have a lot of capacity, so they're still looking to lend. So what are they looking to lend on? And again, there's going to be winners and losers, Barry, as you know. Right now, it's very, very, very difficult, if not impossible, to do hospitality. The hospitality that is getting both workouts and some possible extensions from lenders are the more the roadside convenient hotels, where the convention and downtown urban boutiques are struggling more because their occupancy is still less, because they're more dependent on travel, conferences, things like that. Where are the winners? The winners have clearly been multifamily. Kevin Dillon, who spoke earlier, about the smartest guy I know besides Steve in investment sales. He understands that market, and he's right. We've actually seen both lenders and buyers become more aggressive on multifamily. One of the reasons why, a 2.5% to 3% interest rate on multifamily debt certainly solves a lot of insecurity about collections and so forth for COVID. Now, all the lenders for multifamily, whether it be agency, life insurance companies, their rates are low, but they're also taking rental collection reserves. So they're taking them from anywhere from 6 to 12 months. So in case that there are eviction moratoriums and tenant payment moratoriums, that the borrower can still make their payments to their lender. So keep in mind, the interest rates are good, the leverage levels are still the same. Lenders get a little more particular on multifamily. Now, on office, there's winners and losers. If you have long-term leases and you're multi-tenant, you're going to do better. And we're actually seeing, for years, the trend was away from, as America was going to re-urbanization, we saw the trend of lenders wanting to get more involved in the urban core. So then that was taken away from some of the suburban offices. Now we're actually seeing, with the concern of public transportation, high rises, somewhat, and so forth for COVID, we're actually seeing a little resurgence in the ability to finance multi-tenant suburban office, especially we've got several in the Detroit, Livonia, Troy, Farmington Hills area that we're currently financing and closing. We're doing them with Life and Cmbs. The leverage is a little lower, but again, the interest rates are very good, so it kind of makes up for it in your yields. We're still able to do, we just closed on a $268 million financing for office in downtown Detroit. So it's still possible to do. Rates are still good if you could do it, but it was for a strong borrower, strong location, strong tenant rent roll. Retail has been kind of, if you put the blanket statement that all retail is off the lender's list, that's not true. Both big box is definitely very, very difficult to do right now with banks, life companies, CMBS, whatever. But food and drug anchored, we're seeing cap rates on food and drug anchored centers that are, when I say food or drug, I'm talking that the grocer is taking 70 or 80% of the space. And we're seeing lenders really lean into that, because what COVID did, there was a concern prior to COVID. This made a change. There was a concern prior to COVID that Amazon and Whole Foods was going to put all these grocery stores out of business. Well, they learned to, if anybody adapted and was successful, it was supermarkets who learned to do orders online. You can pick up and delivery, all this kind of stuff. So we've actually seen sales for supermarkets increase, so lenders have much more incentive to invest with them long term on a non-recourse basis. We're also seeing you're able to finance support retail. That's the 20 to 40,000 foot out in front of the park of office complexes or big box stores and so forth. Those are financeable. And then anything that starts with IND, anything that's industrial, lenders are falling over to do, as long as they're multi-tenant, or if they're single tenant, they have leases of 10 to 12 years. And again, we're seeing rates between 2.5% and 3.5%. We're seeing life companies, CMBS. A lot of the banks are still on the sidelines because they're still looking at their portfolio. They were very aggressive in giving forbearance to a lot of their borrowers. Some of the need for forbearance wasn't necessarily needed, but they went and tried to help their borrowers quickly. So unless you're an existing customer or client of the bank, the banks really aren't entertaining new borrowers right now. But all the other product types, whether it's agencies or CMBS or life, are very aggressive. Does that give you a feel for did I hit all the product types, Barry?
Yeah, I think you covered pretty much the full spectrum there, both on the variety of lenders that are active and then their corresponding positions as it relates to the, call it core food groups of commercial real estate.
Low interest rates solves a lot of insecurities for lenders.
It does, especially when you're if you're doing a cash out refi, or excuse me, not a non-cash out refi. I think you're going to have a lot of people that want to be your friend. You know, Stephen and Dennis have both kind of built on the momentum of coming out of COVID, pent-up demand, the availability of debt. You know, Craig, you know, to pull you into the conversation, you know, are there any provisions in the next round of the federal government stimulus that is important to commercial real estate, or, you know, can you weigh in kind of on the things that you do, how that it can assist those that may be looking to get active in commercial real estate today as another metric to add value to their portfolio?
Sure. Todd, if you can put on the slide with the header latest news on new stimulus legislation, please. All right, good. I see the slides up. One of the hats that I wear, I have served on the state board of NAIOP Commercial Real Estate, and I have been a member of the Finance and Tax Subcommittee for NAIOP in Washington, D.C. for the last 6 years. And we stay in front of federal and state legislators and our advocates for the commercial real estate sector. And the topics that are being potentially being included in the next stimulus bill are on the slide on the screen here, including extending the payroll protection for companies with fewer than 500 employees, expanding the payroll protection to include cash advances, providing for a new SBA loan guarantee for employers who have up to 5,000 full-time equivalent employees, and potentially up to loans up to 12 million, and those loans forgivable up to the amount of 2020 losses. And right now, under the tax code, these forgivable loans are taxable if they're forgiven. One of the provisions in the new bill would be to make those forgivable loans not taxable. Right now, commercial real estate sector is struggling with the Treasury's Main Street lending eligibility, so there's some hope that that can be fixed. There could be employee retention credits and expanded worker tax credits for cleaning and sanitizing work and public spaces. The cancellation of debt income and not having that be taxable could be back on the table like it was during the Great Recession. The top bullet on the right column, though, is big, creating a new preferred lending facility for CMBS, where instead of a bank or non-bank lender showing a loan on the balance sheet as a loan, it would be a temporary preferred equity investment, getting cash into the hands of those that need it, those borrowers that need it most. And then the bill could address revisiting the national business interruption risk insurance. You know, a lot of these policies exclude property and casualty insurance policies do exclude acts of war, acts of God, storms, riots, whatever. But we could see some favorable national business interruption insurance provisions, potentially expanded community development financial institutions and their ability to get cash out to borrowers, and restarting the small business lending through community banks and credit unions. So all this is on the table, and NAIOP and Real Estate Roundtable and ICSC and BOMA and all your real estate and trade associations are pretty much all in step and are together in their lobbying efforts and advocacy efforts to get Congress to help. But you know, the path forward is certainly not clear, and there's a lot of haze out there. But you know, with favorable stimulus, we could get through this sooner than later.
I appreciate that, Craig. Thank you so much. I think it really speaks to, you know, when you are looking at investment product or commercial real estate in general, you have to pay attention to the anomaly, this once in a generation moment where the government is putting forth so much stimulus, potentially even more. And, that has a trickle down effect, not only just between borrowers and lenders, but the tenants that are in these buildings. And so if you own a portfolio, there's different metrics, hopefully, that they're achieving to help them sustain in their business, depending on how bad they were affected by the pandemic. Having been doing investment brokerage for a long time, and, Stephen, I know you manage a sizable group of people, and we've been through multiple downturns, whether it was, the dot-com, the financial crisis, 9/11, et cetera, to where we're at today. I liken to some degree what happened with the pandemic as more of an interruption to business, similar to the 9/11 event, in that it created this pullback, this fear, and this uncertainty. Granted, there are two totally different issues that affected our country, but as far as its impact on commercial real estate, because unlike 2008, to your point earlier, where the market just stopped because the capital markets were gone, this was just, oh my God, nobody's working, and the whole economy came to a stop. So, we've had experiences through these downturns, and curious on your views, and really the whole panel, when you're looking at where we're at today, is now a good time to get into the business of commercial real estate? What's your views on that?
You rattled off a whole bunch of previous downturns that we've experienced, and as you were doing that, I was thinking back to 1981, which I think was the first real downturn I lived through as a young real estate person, and that's when interest rates were about 20%. So, this has been a very different event. 9/11 aside, there's been, as I've lived through many downturns now, there's been a common characteristic to them all. They've all occurred for different reasons, but the common characteristic has been the economy, the business world doing things that just didn't make economic sense. The overbuilding of the late 80s, early 90s, the funny money lending of the Great Recession, during the dot-com, selling companies, that have never made money before. All this stuff didn't make economic sense, and it was just a bubble that was bound to burst, and in each instance, it did burst. COVID came out of the clear blue. It has nothing to do with the marketplace. It's a health crisis. As we've spoken to earlier, the economy and the marketplace were in very, very good shape prior to, and I think that foundation it will help us as we turn the corner. Again, when that happens, there's a lot of debate on that, but when that does happen, I think there's a lot of fundamentals and a lot of capital and a lot of pent-up demand. I know that today we are seeing bank reserves at all-time highs and personal savings at all-time highs and corporate cash on hand at all-time highs. So when I hear stuff like that, it's just a matter of time before all this capital gets back to work. And again, going back to a comment I made earlier, I do believe we will see the result of what happens when you have a lot of pent-up demand, and again, I'm pretty bullish that we kind of see some good growth pretty quickly.
Barry, can I jump in on that, because I think that was a great question you asked.
By all means, please.
And you're a master at it. Of finding the right people and qualifying the right individuals or groups to buy the investment sales. That's why we like working with you guys so much, because we can both execute. And you asked the question: is this now a good time to get into commercial real estate? And I think it is, because as Steve points out, disruption also creates opportunity. And the old saying in real estate, you make money on the buy side and just cash in on the sell side. So this is an opportunity, because we're seeing a few things. We're seeing people, because we had a long extended growth in real estate, so we saw a lot of people get into real estate that never should have been. These are people, they had other jobs, they didn't fully understand, they saw people making money and flipping things. So they got into real estate. And then when this little bubble burst, which was a pandemic, and put a pause in the marketplace and put some strain, if they didn't have proper management in place or equity to carry them. Because in many cases, the government, whether it was the state, the local, state, or federal government, told tenants, you don't have to pay. We had national tenants who had credit leases, just said, we're not paying for a few months if you didn't have the equity or the management to carry yourself through. So we've seen a shakeout in people who didn't belong, and that creates an opportunity for people who do belong. So where can you do it? We're seeing it certainly. Somebody mentioned that low-income housing we're seeing people get into. We're seeing some people who historically weren't into retail because there's been such a broad brush stroke against retail buying, lending, and the future. They're going into we're seeing the aggressiveness of going into food and drug anchored and the strips and the smaller strip centers, kind of going against the flow. We're seeing some people start to get into suburban office, betting that it's going to be a while before people want to go back down to urban districts. So I do think it's an opportunity for some people who are already in subsections of owning real estate to expand. And for those who haven't been in the past or were passive investors to do it. Because I also think you're going to see a bunch of older investors, real estate owners, just say, I don't need this anymore. Cap rates are good. Money is cheap. I'm cashing out. And we're starting to talk to some of our bigger clients who have 20, 30,000 units or have 2, 3, 4 million square feet of office or industrial. Start to talk about this, that this is their time. They've had enough. They don't want to deal with this. And they're going to look at exiting. And those are portfolios that can be sold as whole or more likely broken up. And those are opportunities.
Yeah, I agree with you. I think, going into 21, I mean, there'll be no comparison to 20 as it relates to activity or volume of sales. Quite frankly, I think everything's going to pick up quite a bit. I mean, just on assessing kind of the inbound of our pipeline of business today, even from 3 weeks ago, it's a dramatic swing of product that we're already prepping for 21. So, we are certainly very excited about next year and the related food groups that will be transacting there. One of the things that you touched on was, and I think we're all dealing with it, is the amount of how much government is in our face and in our world. And it's a function of the pandemic, which is a health crisis, but then the stimulus component. And, bringing Craig back into the conversation, how important is the federal and state advocacy to protect the commercial real estate sector? What are your views on that, Craig?
You've got considerable daily, weekly, monthly advocacy from groups that represent just about every interest throughout the country that are all competing for and trying to get in front of legislators at the state and federal level. The U.S. Chamber of Commerce, NAIOP, BOMA, Real Estate Roundtable, U.S. Green Building Council, the Mortgage Bankers, ICSC, the National Retail Federation, AICPA, the American Institute of Architects, Big Pharma and Health, Insurance, the utility companies, manufacturing, retail, trade. They are all big on advocacy and raising money and creating political action committees for their members. And if the commercial real estate advocacy efforts aren't front and center, we're going to see some potentially devastating things that could impact the commercial real estate sector. In the 2015 and the 2017 tax bills, Section 1031 exchanges were on the chopping block. Raising the capital gains tax rate to ordinary rates was on the table, and that's going to be potentially on the table again in the next Congress, depending on how this election turns out. Fair taxation, trade, investment, and regulation. In the last two tax bills, the historic tax credits, new market tax credits, low-income housing tax credits were all on the chopping block. But I'm happy to report that thanks to advocacy efforts that support commercial real estate, 1031 exchanges were unchanged, at least for real property. Historic and new market and affordable housing tax credits unchanged. As it relates to permitting through the U.S. Army Corps and the EPA, accounting and reporting regulations, brownfields, favorable depreciation rules. We've seen some really, really favorable accelerated and bonus depreciation provisions in the 2015 and 2017 tax bill. Congress, after in the March of 2020 CARES Act, fixed the retail glitch, which provided for shorter life and write-off for interior remodeling and repairs and bonus depreciation. That could be on the chopping block. Transportation and infrastructure is a big deal. Healthcare, energy, cybersecurity. I mean, all these things impact the commercial sector, capital markets, and finance regulation. So, the current administration has been very supportive of the commercial real estate sector. The commercial real estate sector was the largest beneficiary by far of the 2017 tax bill and the easing of capital markets and finance regulation since 2017. But we're not at the table. Our industry could suffer.
I appreciate that. I think, again, it just speaks to, the fact that commercial real estate encompasses a lot more than, the four walls, the roof, and the tenant. It really speaks into, how that asset's going to perform and the government view on it for those opportunities or threats, and then obviously the capital side to it. When we look at valuing real estate today, Stephen, and I'll even throw this to Dennis as well, and an opportunity comes in the door and we've got to underwrite it and figure out kind of its position in the market. Now that we're kind of coming out of COVID, what are your views on what's driving value today? Is it, as far as pricing is concerned, do you think it's the fundamentals and the tenancy, or is it the product type, or do you think it's perception of the product type or the market? Now, I know that's a lot, but I'm just trying to, talk through, people that may say, hey, is there a bid-ask gap between pre-COVID to post-COVID, and why? Or going forward, is that going to get better? So, again, I know that's a lot of vagary with a fair amount of topics, but hopefully I think you understand the vein of the question that I'm trying to bring to you.
Just a couple comments to some comments that Craig made. As an industry, it would be devastating to lose the 1031 exchange law. It would be devastating to see capital gain rates go way up. So to the degree that does get some momentum in Washington, we as an industry, I think, really have to come together and figure out how to avoid that from happening. So just a couple of comments there. In terms of the marketplace, as I said earlier, it's a marketplace really unlike most that generalizations are not applicable. You really got to look each deal product by product, market by market, as it comes to underwriting them. Although I think we're at a point in this marketplace where the uncertainty or the fog in the air is cleared to a sufficient degree that underwriting is nearly fully doable. And the way we're looking at it in most product types, and again, you got to be careful not to generalize, is the first year, the first 12 months of the investment, and then the second year and thereafter. So when it comes to the second year and thereafter, when say you're running a 10-year IRR model, we're kind of back to underwriting that aspect of the deal similarly as we have. When it comes to the first 12 months, it really comes down to the real estate and the performance of that real estate and what do we think is really going to happen in this first 12 months when it comes to zeroing in on the first year NOI. And that's a little all over the board right now because the nature of the marketplace. But on reasonably good apartment product as an example, it's not hard to forecast that first year to be relatively stable with good rent collections and ground out the NOI and go from there. So when it comes to underwriting, I wouldn't say we're back to normal, but we're not far.
Yeah, for us, it's a little bit similar. I think we're spending a significant amount of time on the tenancy of the deals, obviously excluding multifamily. And, especially if the product is office centric, we're spending a lot of time on that tenant profile and really what the culture use is of that tenant space because of the concerns of, is there going to be a downsizing component? What is that metric? Is it 10%, 30% based on companies' abilities to remain profitable and get good productivity out of their employees with remote working? And so I think, where you have a office product that has tenants where it's very obvious the culture of their business needs them to be in the office space, it's much easier to kind of sell through the likelihood that that tenant isn't going to go anywhere or downside. And then conversely, if the tenant has a huge concentration of workflows that could be done remote, maybe there's some threats there. But I think the comeback of pricing is not as bad as a lot of people want it to be, because I think there's a lot of folks hoping that things get a little worse just so they can get better buys. Time will tell.
If I may, we're missing an opportunity. I mean, that guy is sitting around waiting for distress, is seeing deals go by him. So,
right.
We're seeing the disconnect, Barry, and there is a gap in perception and value between sellers and buyers and lenders in this regard. The seller sees the low rate, so they're thinking low cap, low rate, higher value, where the buyer now then looks at, he's got the lower rate, but he's then breaking it down by tenant and how does it play out for COVID? And then the lender, who doesn't like to take risks, sellers and buyers, owners, equity guys take risks because they don't have a fixed rate of return where a lender does. They just want their money back. They'll just settle for their 2.5%, 3.5%, 4%, years ago, 6%, whatever it was. That's all they want. So lenders are there's a disconnect on the risk profile that lenders would take. And then within the lending world, for instance, for multifamily, you would think if you went to three different agency lenders, three different Fannie Mae lenders, and gave them the same acquisition, you should get three identical quotes because it is a national program. Every time we do that, we get three different quotes back on leverage, on reserves, on spreads. And the reason being because those lenders take a loss position. So every and same thing with CMBS. Now they take the first loss position. Agency lenders do. And life companies, of course, take the whole loss position. So the disconnect still is the lender may see more perceived risk in how those office tenants are going to renew or the amount of space they will. They take a hard look at who the tenants are, what industry they're in, how is the layout? Is it the modern layout where you have 100 people crushed into 100 square feet, and you got 6 people to every table kind of thing? Or is it already spread out? Is it somebody that needs to be in this space, Barry, but they're already crushed in? So does that mean some will work remote, but they're going to have to spread out? So the disconnect is also with the lenders, not all, and the way they're combating that is even on national programs like agency, Fannie and HUD and Freddie and CMBS and Life. There's so many different, we send them out, we're getting different quotes across the board because that's their investment committees deciding on their tolerance for risk. Make sense?
No, it does. I appreciate you expanding along the topic that we've been going through. And I know you're touching on it with your answers to these questions and demonstrating, obviously, the knowledge that you've got, Dennis, and dealing with so many of these loans. For the benefit of the viewers, can you touch on what are the primary differences between using a mortgage broker versus going to maybe your local bank for debt, so they understand that, how you kind of fight for them and how that all lines up, please?
My pleasure. First, it's really important to use a mortgage broker because I have an exorbitant lifestyle that my wife expects me to maintain. And so it's really, along with the other government bailouts, I really need a mortgage broker bailout. That's the honest part. Okay, here's the business side of it. We have mortgage bankers have, if you just go to your bank, they only have one product to offer. And if they're in the market or not in the market, that depends what they're doing. Right now, if we counseled a lot of people that if you only had one bank you were doing business with, but they're doing everything for you, what do you do now if that bank is on the sidelines? Because several banks are. And mortgage bankers introduce you to multiple lenders. Also, historically speaking, because of, for instance, a lot of these urban developments, multifamily with retail, if you've been just dealing with one agency lender the whole time, they may not have the same risk tolerance that you want to have for the kind of loan that you want to get, and maybe you need to be introduced to other Fannie lenders. Or we're closing on a loan today in the city of Detroit, and because the retail component was so large versus the multifamily, because there was retail, office, and then multifamily up above, the agencies weren't able to effectively do it. We were able to get 10% more money and at a lower rate actually on a CMBS loan. So a mortgage banker, we're in the market all the time. Bernard Financial, we have 18 life companies. We got some life companies that only do 1 to 5 million in loans, and we got others who don't get out of bed in the morning unless it's a $40 million loan, and everything in between, multi-tenant or single tenant. So what's good is, to be honest, mortgage bankers, the established ones, like market stress, because when everything was good pre-COVID, everybody was a mortgage broker. Everybody can go get money. Now they need us again. We can charge full fees again, which is a good thing for my lifestyle. And because we're able to find out who's truly lending and who's truly not. We have some lenders who claim to be in the market, but they really are brokering to another life company or a pension fund, so it needs other sets of approvals. CMBS lenders who actually are selling, they can't close the loan until they sell it to another CMBS lender. Believe it or not, that's behind the curtain. And good mortgage brokers know where they are, so we do pay for ourselves. And then for the final thing is, for our CMBS Life and Agency, we're your servicer. So we were hit when COVID hit. Within the first 4 weeks, we had 70 out of our 520 some odd loans. We had 72 requests for some sort of forbearance. And within the first month, we were able to deal with all but 3 hospitality loans. Everybody got some level of forbearance or something. So they didn't have to wait for master or special servicers. They didn't have to themselves know how to go and talk to their bank. We had life companies who said, here's our national platform. Here's what we're doing for everybody. So those are the reasons.
I appreciate it. We're kind of getting close to the end of our time here. So I'm going to ask kind of one global question to each of the panelists, and then depending on what questions we have, we'll try to do a little bit of Q&A here with a little bit of time that we have left. Starting with you, Stephen, over the next 12 months, do you think the local investment market, commercial real estate market, is going to get better, worse, or about the same as it is today?
I think we'll see it get better. One thing that we haven't spoken to in terms of the overall market is there are few deals out there. And as we've been speaking to, lots of capital. And one of the reasons that we're seeing pricing, particularly on stable deals, many of which we've talked about here, that we're seeing cap rates, pre-COVID or even compressed beyond pre-COVID is because of the amount of competition that exists in the marketplace. So just as an overall statement to the market, going back to that, really, to some degree, a very strong seller's market. But in terms of moving forward, I'm bullish. What I'm telling my guys right now, this is a great time of this cycle to get our pipelines together for 2021. And I'm pretty certain 2021 is going to be better than 2020. Although for my office, 2020, I think we might actually end up a little bit ahead of last year, knock on wood. And for those in my office that kind of have said to themselves, what's COVID? And they just kind of been executing like COVID doesn't exist. They're having pretty good years. A number of people in my office having better years than last year, and a number of them having record years. So I think that momentum will carry over for us in 2021 as the pandemic gets further behind us and we get back to a more normalized world. So I'm excited.
Thank you. Craig, your thoughts?
Well, the construction statistics were not good in March, April, and May for design build or for, an owner making improvements to existing property. I want to say that statistically we were at the highest construction employment in like 13 years through February. And then March and April saw 1.2 million jobs lost. About 500,000 of those were hired back by June, July, a combination of states reopening and the payroll protection loan. But the industry did see a shortage of craft workers and subs, and in some states that's still the case, whether it be due to illness or family members ill or workers choosing not to work because of the disincentive that the higher federal unemployment provided for. As always, construction is usually one of the first into a recession and is late to recover. Fortunately, the availability of capital is good. There's pent-up demand. Money's cheap. The opportunity zones, have offered a really good lower cost of capital investment opportunity, and a lot of those projects are just coming online now. Those first round of opportunity zone projects coming online in 2020. If we can get over the delays and disruption in materials and supplies and manufacturing of construction materials and supplies and the shipping and logistics, we had some serious disruption and interruption in May through July. But the good news is if you're an owner, a lot of owners are remodeling and renovating. Indoor air quality is going to be probably the biggest capital outlay for owners who either are owner occupants in their own building or based on tenant demand in leased space. The technology that's out there for air sterilization through air handling and HVAC, there's a lot of technology out there for indoor air quality and sterilization. So I think 2021 is going to be much better than 2020 for sure. So I share your guys' optimism too going forward.
Thank you. Dennis, if you could, and I know this might be a little challenging for you, buddy, but keep it quick because
I can't say goodbye in 1 minute. All right, do it real quickly. I'm concerned about. We're coming back. We're doing fine. We're going to be. Our volume will be short of our typical 1.3 to 1.5 billion, but we're probably going to get awfully spitting distance of $1 billion this year. I think next year we'll be back. I'm worried about the coastal effect. In that large urban cities on the two coasts are going to have bigger issues in their urban core, and that may upset lenders. And then they, as always, they start freaking out about the Midwest and Michigan, where historically, even back in the Great Recession, we had less givebacks than the coast, and I'm worried about that. But if everything stays normal, lending will stay strong for a while.
Thanks, Dennis. I apologize to John, who's got a question in. We are pretty much out of time, but John, I do see your question, and feel free to call my office line, and I'll be happy to answer that question for you. Outside of that, gentlemen, thank you so much for taking the time today, and really appreciate your feedback and input to this panel, and hopefully the community that has participated has gotten a good takeaway from it. And I mean,
great job, Barry. Great job.
Good job, Barry.
And I think, quite frankly, we got nowhere to go but up in 21. So, all right, everybody be safe out there, and have a great day. Talk to you soon.
Yeah.
Thank you.
Wonderful. All right. If you're watching online, head back to the lobby, close this window, open up a new window when you get to the third panel, and I'll see you all there. Good job, everybody. Craig, good information. I appreciate that legislative update.